Good morning, everyone. This is Mortgage Post 411. I'm Audrey Boissonou with my co-host Kevin Casey, and today we are joined by none other than Bill Dallas. Can we call you a mortgage icon, Bill?
Please, I mean, whatever you want.
We have one friend.
Just don't.
Every time I say icon, he cringes and acts like I've just punched him. Anyway, good to see you. Thanks for being
You
here.
too. Thank you guys for having me again.
Appreciate it. Okay, well, I'm just going to start off with it's NMLS renewal time. It's December, whatever it is. And if you haven't done it by now, you need to get on it, people. If you haven't done your continuing ed, you're in for a real rough ride because it's all online at this point. So schedule like 3 days for that. And as far as
Big companies are going to pull your access. They're gonna keep you from you won't be able to get into LOS if you're not careful.
Exactly. So it's a hard stop on.
But you know the one really great thing about the online courses?
They make you appreciate the live courses.
They make you appreciate the live ones.
Yeah. Do you know how many people we have in the live courses who came from the online courses? They're like, it takes way less time, much more entertaining, so much more information. Just knock it out and move it along. And if you're
and they have like a step-by-step what they need to implement as soon as they get to office next day. So like they actually change their behavior.
People in our class,
I just need to memorize some stuff so I can answer these questions at the end of this section.
people in our classes literally leave with a to-do list, so that's good. Okay, so just to be clear, it's as always an eventful week. So tomorrow we have CPI for November. That'd be the Consumer Price Index, and of that, shelter is 46% of that index. It's the reason it has been so slow on coming down because that shelter lag has really been a problem and will continue to be a problem probably for the next couple months. We're also replacing really low numbers from last year with slightly higher numbers from this year. So the Fed is aware of this, but the market is going to see whatever the number ends up being, and we'll see what happens. So just
Audrey, what you're saying then is if landlords all go out tomorrow and drop their rents by 10%, we would see a great drop in inflation rate, right?
No, it's still going to have that. It just takes I don't understand why all the everyone else can get the rental numbers, to be current, but somehow we can't get them into.
Well, actually, what we need is people to think that their places will rent for less. That's all we need. People to think that their places will rent for less.
Yeah. Okay, so moving right along. So we also tomorrow have a 10-year treasury auction and mortgage applications. Thursday, we have PPI. That'd be wholesale inflation. Same problem. This one goes into PCE. So we got that going for us. We'll also get initial jobless claims, and we'll have a 30-year bond auction on Thursday. So again, buckle up, kids. And, I have a few loans that I'm floating right now. Today, the market is sort of gotten a little better, actually, as the day has progressed. So I'm sort of hanging on, but yeah, I don't know. Yeah.
I'd say if you see a rate you like, lock it in.
Listen, if you're going to say that, you have to sing it. If you see a rate you like, lock it in. If you see a rate you like,
lock it in. I like it.
I know.
If you see a rate you like, if you see a rate you like, if you see a rate you like, then lock it in.
I know.
Yep.
I like it.
We've been singing that since we started the show for almost.
I've been singing that since 1980. For crime's sake.
And also we have PCE coming up on December 20th. That'd be 2 days after the Fed's decision. And currently they are saying that we'll have a 25 basis point cut, even though the estimates for next year have definitely come down. So now they're saying more like 3/4 instead of whatever they were saying before, because it's a moving target. And Powell made a few comments last week and is much more positive, maybe put some sugar on his Wheaties. Who knows what happened? But he was definitely feeling like there's no rush to lower the rates anymore because things are looking solid and good. And, but the inflation numbers, we better watch it, et cetera, et cetera. Good God. So what are your thoughts, Bill? Dallas?
I think you're going to get look, if I was a first-time home buyer and I had to make New Year's resolutions, right? Yep. I would probably resolve for 3 things, right? Today, I would want more inventory. I would want falling interest rates, right? And more, and then I'd want somebody to give me money for a down payment, right? Nice. Those 3 things are across the board. And what you're going to see, I think, and you see it in almost every forecast. I mean, you talk a little bit about inflation. I think the current administration, the new administration, was basically hired to keep inflation down. I'm not sure that they can do that. It's very complicated, as you just said. But I think what you're going to see is you're going to see falling rates. And mortgage bankers are going to be in a decent environment for the next few years. I don't know that you're going to get this linear drop, but I think you could probably find yourself in the 5s, right? And I don't know that you're going to find yourself in the 4s over the next, 2 years, but you might, right? You just never know. But I do think, so you look at unemployment and you look at the yield on the 10-year. The 10-year, I think they like Besant. I think they like him. I think the market likes him.
Yep.
I think he's now said, I'm not going to declare war on Powell, who he actually put in office. So I think what you're going to see is you're going to see a cut coming up. You're going to see a continued cut. I think it is going to be very measured, but you are going to get, for mortgage bankers, you're going to get a little help in interest rates. I think the second piece is that I think, like we said, you need more inventory. I think more inventory is showing up. I think prices are flat to falling in many markets. Maybe not in the most desirable markets, but like in Malibu with a fire going on right now, it probably is falling, right? So when you look at it and you look at areas, I think highly desirable areas will continue to be cash and push and blah, blah, blah. But I think the rest of America, you are going to get some falling prices. You're going to get lower rates, and the first-time home buyer is going to get their wish. I think that is a good environment for mortgage bankers. And like you said, Audrey and Kevin before, you're beginning to feel it in December.
Yes.
Right?
Yeah.
I think, and so mine is, how do you thrive in 25? How do you take advantage of these things? And what can we really expect? And how do I prepare myself if I'm an LO? Right. And so I spend all my time with my clients trying to help them make sure their organization is ready, and they're not. I mean, it's amazing how little strategic thought goes into what's going to happen in 2025.
I think that the average LO still today is thinking, oh, if just rates would come down. If rates would come down, then I would just be magically flooded with new inquiries for everything. And that's not the case. Okay, I want to go backwards a little bit. So first of all, I saw this, it was really, we talked about the Jerome Powell press conference after the last Fed meeting, where he was asked point blank, are you going to resign? And his answer was one word, no.
No.
And that was it. And of course, this, brilliant press corps couldn't just leave it alone. So they kept coming at him. But I just thought that just the what, no. Okay, so President Trump has said he does not plan to replace him. Okay, so I love the way he put it, though. So he said, asked if he would try to remove Powell. He responded, no, I don't think so. I don't see it. He said, I think if I told him to, he would. But if I asked him to, he probably wouldn't.
So Trump.
But yes.
Yeah.
But if I told him to, he would. I mean, so anyway, bottom line is he was appointed by Trump. He was kept by Biden. This idea that somehow, Powell is some sort of political football is just, ugh. But anyway, his term expires in 2026. So let's just expect that to stay the course. With that being said, your comments about Besant were right on the money as far as the markets like him. He seems to be a moderate. He has a good reputation. He's very successful. And he does not seem to be so on board with his tariff idea. So the 100% tariffs for, Mexico and Canada on day one, maybe he can moderate that a little bit, because if he doesn't, then our inflation numbers are not going to be better and the rates are not going to be better. So hopefully, he'll be that voice of moderation that
I think what Mexico and Canada should do is say, you know what, you're right. We're going to just self-impose these tariffs, and that will drive your inflation up. You'll be out of power in a few weeks, so you might want to rethink this.
Well, considering we are 27% of Mexico's GDP are exports to the U.S. and 21% of Canada's GDP, they're not doing that.
They can't do it. They physically can't do it. Because,
Trudeau did go visit President Trump immediately after
oh yeah,
Mhm.
comment. So we'll see what happens.
he's just doing a power play because honestly, you can't have an American car. It's so built between we were there in San Diego and we watched all those cars going by on that train one day, remember? And it was just one F-150 after another F-150 for about 20 minutes of a train driving by with hundreds and hundreds. And these cars are all on the trains as they get built. They just move between Canada, US,
Mhm.
Mexico, back and forth until the final product is made. It's so intermingled that you can't just separate it out.
We're much more global,
Uh-huh.
right, than we think. And yet I do think there's some benefit to intrinsically looking at America and trying to keep America strong, but you can't, it's like anything else. You can't keep America totally strong by closing your borders and closing immigration and closing all these things. You have to do it in a measured way, and you have to do it. I mean, I think what's interesting is it's like underwriting guidelines, or it's like we talked before when we started, right? When you came out of 06, 07, and 08, you saw this massive swing to conservative, shut it down, government reg, blame people, and do all that. And you're seeing the same thing really in this global economy. I mean, we've never really been challenged before as a nation. We're being challenged by China, right? I think the world has found its culprit, right? Really, or the bad guy, which is Russia. And then you've got this massive mess that's always been a mess in the Middle East, right? And all of those things are hotspots that could trigger whatever, right? And I think what we have to do is we have to, as a nation, continue to be focused on housing, education, right? Which we sort of suck at these two things right now. And I think making sure that you create enough, maybe if you really think about where we are, right? As like we started as farmers, my whole family everybody was in agriculture, and you sort of went from agriculture to machines and supply, and we spent all this time manufacturing. And now where are we? Well, we're in the early stages of data and the use of data and analytics and technology and all those things to change how we live. And everybody needs to get in lockstep, and that doesn't happen in 5 minutes.
No.
Right? Whether you're trying to retrain people in college, you've got more STEM going on. I think you've got more women attacking college, probably better than men. You've seen that shift over a long period of time. And I think now people are trying to, forget AI. I'm not even going to go there. It's just so, extraordinary, but it's another piece of what happens to employment. And look, I would have never thought what is full employment? I think we're at full employment now. We got 4% unemployment. And you could work anywhere. There are so many jobs available in different things. It's just, will they pay well? What are they going to do? All of that, it's focused. We just aren't focused on housing and education enough to try to get people into that stream. And that's very difficult, I think.
I agree. I think that the transitions, anytime you're trying to transition people from one idea to another or one way of life to another, it's very difficult and it does take time. I think that we've been trying to shift away from more of a global economy for the last few years, and it's a little difficult when it takes 1,000 different parts to make an iPhone, and a lot of them come from places in parts of the world that may or may not be accessible if certain political events happen. So it is tricky. It is not a
simple, it's not an easy task.
Simple about it. And I feel like we are, as a society, we want simple answers, neat, tidy, in the box. I find that in lending. The GSEs create this little tiny little box, right? Everyone's supposed to fit in it. So for years, if you were self-employed, you were screwed. If you didn't fit their little guidelines exactly, you weren't getting a loan. And now that has evolved. And part of it is because the GSEs have made life so uncomfortable for people as far as the cost has risen exorbitantly if you're trying to do a second home or an investment property. So that now 9 times out of 10, my investment properties are going non-QM or private money. They're not going to the GSEs. Okay, so they wanted to accomplish that. There you go, right? But it is this one size fits all. We are human and none of us are the same. And so we've got to be a little more accommodating, but also realize that just because you did this and your dad did this and your dad's dad did this, it doesn't exist anymore because we're not bringing
Nope.
Yeah.
to manual.
So stay with that for a second. You've got, like looking at like Fannie Freddie. Let's talk. I mean, you've seen Calabria, he's been out and he's talked. And look, we've been connected to him for a long time. FHFA is a whole nother, it's got one job. It manages the agency, right? That's it. They've been now in conservatorship for almost 2 decades. It's time. And I think what you're going to see is it's going to take some time, but you're going to see Fannie and Freddie migrate from full conservatorship to private, maybe even quasi to start, quasi government, so it can get itself out, because it's not that it's a problem. I mean, it's making bank for America, right?
Yeah,
We should probably have more Fannie
money.
and Freddies. They make so much money. I mean, look, if your options are, how are we going to pay for all of this? Would you rather be taxed, or would you rather have things that businesses and things that actually work that make money for the government, like the United Postal Service or Fannie Mae and Freddie Mac? Yes. So I think our goal would be, we are going to see them, I think, come out. I think it's going to take some time, probably a couple years, for them to actually get on a path that makes sense. Fannie and Freddie, both the management teams of Fannie and Freddie have been working on this. They have all these plans set in place. They've been working on this for 10 years.
Right.
So they're ready to go. It's just, how's this going to work? Is it good for the consumer? Probably long term. It's really good because they haven't changed their guidelines in 100 years.
No.
Right? It's very restrictive. I mean, if you really think about 2025, I mean, 2 of the products that, Fannie Mae and Freddie Mac and agencies like purchase and rate and term refis. Those businesses have been built on those things, right? And so when you think about this, what is next year going to be like? It's going to be cash out refi and people that can't afford stuff trying to get loans,
right?
Which means non-QM to some extent and cash out non-QM. So how the agency, if you put them out, and they would be probably 2 of the best conduits on the planet. They wouldn't be restricted by some sort of loan amount limit. You wouldn't have conforming high bow. You wouldn't have all this bullshit that we have to traffic around, especially for all y'all in California where home prices are here. So I think there are some good things, but to the consumer in the short term, it probably means a bit higher rate, but a way that they can actually probably qualify. So, and which would be, I think, interesting, right? It's something for all of us who've been in the business for 40 years. I mean, I was in it when there was no Freddie Mac.
Wow.
Right? It's like, holy shit, you're old. Yeah. I mean,
wow, that's old. Hey,
hang on. I just want to make it super clear that what we're discussing is whether or not the GSEs, Fannie Mae or Freddie Mac, should come out of conservatorship. And it is a wild conversation out there with all sorts of opinions all over the place. So what?
They have to come out of conservatorship.
Well, okay.
The question is whether they're private or public.
Right.
But they have to, they can't stay in there. They have too many stockholders and too many people that are stuck in this that they've got to do something with it.
You say they have to, but they've been in there for far longer than anyone ever expected. It was never supposed to be like this. And to be clear, to your point, they're in conservatorship, and then the whole not private thing is a whole separate thing, right? Because So the
Harder.
was supposed to be a temporary fix. That's how it was written. That's what it's supposed to be. So the fact that they're still in it 12 years later is crazy. That I give you. There are a lot of different opinions out there. I have heard Bob Brookschmidt with MBA talk about this. Seems like they're very supportive of them coming out of conservators. I've heard Mark Calabria speak twice about this recently. Very interesting to hear his take on it. Heard Chris Wallen speak on it. I mean, opinions all over the place. So this is what I have gleaned from some of this. First of all, the federal guarantee is a big question. Will we still have the government backing these securities? Also, there needs to be an operating plan. Also, how are the ratings agencies going to address this? And even if they do come out of conservatorship, the US still owns, I mean, like a ton
of it.
I mean, it's crazy. So I'm hearing that the G fees are going to go up maybe as much as 3/4, and it will potentially create, at least temporarily, some major instability as everyone figures out how this works, right? So, and also more to the point, the timing. So it sounds like a legislative fix is not on the table or something that there's an appetite for, and it would take years and years to get through that. Chris Whalen.
And you don't, I don't really think too, legislative, stay there for a second. You don't have to have a legislative fix.
Right, exactly.
Right. FHFA can do this.
Right.
They just have to do it. And then not, I mean, look, before you had both houses, one Democrat, one Republican, you had FHFA, you had more, I think Democrats in general, right? I think all of us in housing, I'm all for Fannie and Freddie staying around and being Fannie and Freddie, the Fannie and Freddie that we all knew. Right, that was our part, right? I think giving them, like you said, the federal edge in I think the banks and Fannie Freddie have a pretty big edge, right? Banks have lower costs of capital. Yeah, because of deposits that they glean from all of us. They give us 2 and they get to keep 8. Yep. Right.
Actually, so they charge us for the money we deposit. So
well, it's a stupid business for us, right? And then on the flip side, you've got Fannie and Freddie who just by the guarantee, whatever that, right, the implicit guarantee, it's not formal like FHA and VA or Ginnie Mae. So I think it's going to be easier to tweak that. But like all those things you said, Audrey, about all the stuff that we've got to worry about, people have been opining and working on that for 20 years. So we've got strategies and thoughts of how to do that. That's why the MBA supports it, because I think we need strong conduits in our space, and we just don't have them anymore. We have weak agency conducts. We have the government, which is just massively messed up with FHA and VA. There's nobody home over there. It's like running the U.S. Postal Service again. And then you've got all of the Wall Street firms on this side that are trying to securitize and trying to develop. So I think if you took that entire market, we've got agency and non-agency, right? To a consumer, to your client, they don't care who they are.
No, they don't.
They don't know they're subprime or prime or blah, 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 right? They don't know that you can't do this if you're over 780 and you can't do this. So I think all of that gets better. And that's one of the reasons why technology hasn't worked in mortgage, right? Because you have to do everything in triplicate. You got massive redisclosures. How many redisclosures you guys got to do? Right, yeah, 20, right, per deal. So I think all of that needs to, and what you're seeing now with DSCR and non-QM, and some of that is that the ease of doing loans, like you both have said, right? If I'm a non-owner and I want to go do a transaction and I meet the DSCR requirements,
a lot easier.
So much easier. Easy deal. Yeah. So right. I think all of that gets better. Right. And so when we looked at it, I think conservatorship, what I would want all of our listeners and everybody here to say, look, we should support it, obviously, in the right way, and the MBA sort of does. And then I think what we should try to do is say, look, how they come out from conservatorship is going to be simple. How they use the federal government going forward is going to be complex. Very much so.
Yeah, I mean, so anything including involving the government is never going to be simple. Let's just agree on that, shall we? And it is, again, there is going to be this interesting dynamic in this administration, because we know that the election cycle starts, in 2 years, maybe even the day after, maybe January 21st. And so how much can be accomplished, whether
they have literally 2 years at best to get stuff done.
So Scott Bisson, I don't know where he stands on this, because they're saying that Treasury is 100% going to have to be behind this to get it done. Anyway, it'll be interesting, but ultimately it sounds like we need to really buckle up on our non-QM, our anything other than Fannie, Freddie. If all your eggs are still in that one basket, you're going to be dead in the water, I think, because there can be a certain amount of product that goes to those loan programs, but there is a whole wide world out there that you're missing out on if you're not looking at non-QM. And so every time we have you on this, Bill, it gets pushed it's left to the last minute. So I want to take a moment in the middle of this time to give you some time to talk about one of your favorite subjects, which is equity share. So let's talk about your thoughts on shared equity programs. We know that we had the California Dream for All that embraced this big time. And we're hearing, we've had different people on discussing this. So tell us your perspective and why it's important, how it might work. And also throw in the fact that CFPB is not a fan, and why that is, and what do you think?
Yeah, it's different, right? So I think I wrote an article for US News and World, and they were asking me if I was a person trying to take cash out of my property, which I think 2025 is going to be totally different because it's cash out.
Yeah.
Which means agencies hate cash out. They do it, but they don't like it. They restrict it. They don't understand it. It's a different deal. It doesn't fit sometimes day one certainty, blah, blah, blah. Right. So I think the major theme is, okay, we have tons of equity, and 2025 is how do we get it out? Right. So when you write, when I was a loan officer, like each of you, if I have this conversation with the client, right, I have to start with, this palladium of, could you do a second? Could you do a HELOC? Could you do a new first? Right? Then it gets a little complicated. Are you over 62? Do you want to do a reverse? And then the final frontier is an HEI, a home equity installment contract. So if you look at the options, the difference is nobody really knows how, because it's not a loan, it's a lien. Nobody knows how to disclose it. Nobody knows how to do anything with it. And it's just it's like you've thrown a banana into a bunch of oranges, and people go, what am I going to do with this thing? So what I think but it is, if I'm talking to a client, if I have tons of equity and I want to take it out and I don't qualify in the traditional ways, shouldn't we give it to them in some way?
Yes.
Right. It's theirs. Do they have to sell the house in order to get the money?
Yeah, they do.
Yeah, they do. So I think what is happening, and you see this at, you see Point, Unison, Home Tap, some of these they were all consumer direct companies coming out of San Francisco, right, initially. And so what they've done a couple securitizations, but at the end of the day, the challenge is it's not a loan. So mortgage people don't know how to disclose it, get paid for it, and do it. At the end of the day, it's very good, in my opinion, for a client to have that option, because if I can't qualify and I have a lot of equity, normally what lenders do which is stupid, right? We create default. We give you the money, charge you a lot for it that you can't afford, and then we
Right.
wonder why you didn't pay.
Yeah.
And then I got to foreclose on you, right, to go get the money. So wouldn't this be better if you could actually bring in an investor who sat alongside you and just waited and gave you the money? That's an HEI contract.
I
Yeah.
think part of the problem, because we had who was it, Kevin? Is it NewFi? NewFi had
NewFi.
equity
Yeah, they came out with a really interesting program.
The
mortgage.
second,
But-
yeah, it had to be, you know, and they sort of, I think I'm going to tap my guys, right? I think we sort of created it, and John Wise and the guys at Equify, right, liked it. So Apollo stepped in and created this mini second with a little bridge to it, right? It's pretty cool, right? But it's a loan, right? Now you can
Big
actually,
loan. Yep, and you have to qualify.
you can
But
do it, which I
getting-
think is great.
brains around this idea is tough, and also being able to quantify, is it fair? I think that's part of it. Okay, you're telling me you're gonna, take the appreciation off of core CPI or CoreLogic's equity home appreciation index, but your percentage and the fact that you're giving me a 5% haircut on my value up front, et cetera, like it's hard for people to understand. It's not black and white.
They don't understand the risk to it.
You've got it, like you said, I think you've got to keep it. Well, look, it's new.
Yeah.
Investors want to hire you. I mean, look, investors, if you sort of just line these up, right? I'm selling to the agencies, going to be a lower rate. I then move up to selling it to non-agencies, it's going to be a little higher. And then I move over to here and I'm doing an equity share.
Right.
Going to be higher yet. So I think there is no free lunch.
Right.
But if you aren't going to make a payment, you are going to pay a VIG to someone for the opportunity to get this money. But I think the opportunity, I think it still in some ways puts the investor alongside with the risky borrower in the same boat. And the investors cheering on, you're going to sell the house, you're going to pass away, you're going to do something, right? So I can get paid. But at the end of the day, they're not foreclosing on you.
Right.
If we gave you a risky loan at a higher rate, which is our option. So I do think it's got, and an HEI, I think there's probably only 2 or 3 deals done on the planet to securitize them. It does look a lot like a reverse in some ways, right? If you're gonna, which, at Finance of America, we're still the reverse king or queen. And I think, look, when you're talking to a client, I would love to have us as mortgage bankers have this option.
Yeah.
Just to be able to offer it.
Yeah, we
definitely. Hard money is not sometimes the best thing that we could give a client.
Sure. The most important thing about doing a private money, it hurts their feelings, Bill. Don't call it hard money anymore. Come on. So when you do a private money loan, though, the most important part of it is what is your exit strategy? Because the terms are very short typically. And so you better know what earth you're getting out of that thing and your borrower's getting out of that thing, and know that, it's got to be something that really is going to be there in 12 months.
Yeah.
Whatever.
Well, think about a reverse and then think about the HEI. The reverse is your exit strategy is you have to pass away, right? But they figured out that the number one thing is it's a mortality table, not an interest rate discussion. So they manage it that way. On HEI, it's just they assume that home prices are flat to going up over a period of time. They give you, I think a lot of these started at 30 years and they've compressed back to 10, which 10 years of free payments, free money, probably pretty good, right?
Yeah.
And I just think there's a lot of work. I mean, at Equify, I was originally with, and I've worked strategically with Equify in San Jose forever on this product. And it's just a nasty product to try to get through a lending industry because it's basically an equity share. And it's not, there's not a big backing. There's no federal backing for it. There's no securitization backing for it. The banks don't back it. So where's this money come from? Right? It comes from insurance companies.
Yeah.
Big insurance companies. And the thing I would say to all of us, the biggest change I've seen in the last 3 or 4 years is the amount of insurance companies that are now merging with what I'm going to call the Aries, Apollo. I'll use Apollo, which most of you probably know Apollo, and Athene. Athene is their insurance. Those merged. You see Aries, you see Blackstone, you see BlackRock, you see these names, but why? You can move the insurance. The insurance gives you, the insurance money gives you the ability to long-term. Insurance is a long-term investment. And mortgage and loans are short-term. So when you start doing things like this, having the access to long-term money is good. The other thing that insurance companies do, which is, I've never really understood it, is everything's freaking offshore. It's some tax strategy thing that only some smart person from Harvard could figure out why we're in Puerto Rico and then we're in Luxembourg and someplace else. I mean, I've never been in an insurance discussion where somebody's not talking about offshoring the capital, which makes it cheaper. So yeah. I don't know. I like the opportunity because all of us in our careers have never seen anything like this amount of equity.
Right.
So how can we help, I guess?
Yeah.
What about, and no one's ever talked about this, but what a reverse second loan? So you keep
we do it at Finance of America does a reverse second.
Really?
Yeah. And but look, I actually think it's I think that products need to be more focused, like almost like what you just said, Kevin. We sort of say, I mean, it's like shoes, right? Everybody, I want to go buy a pair of shoes and I'm an 11.5. Okay. Yeah, I'm at 11.5. A, B, C, double D, E. I mean, shoes, we have one size. And what? It's going to fit everybody? You got to be shitting me. So it's the same thing in mortgage. And I think what we've done is we've said we've got one size. Everybody has to fit it. I've always said the key to creating underwriting rules is to customize the guidelines so that our clients see themselves in the guidelines. Yeah. If I'm self-employed, there ought to be a shitload of things over here that I can go, wow, okay, perfect. This is great, right? Because now I can qualify versus not. And I think what's happened is we've spent so long with this one size fits all thing. And Frank Raines was probably Jim Johnson, Frank Raines, all these guys who ran Fannie Mae. They always used this strategy, which they called customize the commodity so that it fits a consumer. And I think what's happened is our consumers gotten so foobarred that they just have gotten way out there. I mean, almost all the people that I know are employed and self simultaneously.
Yeah.
So did we build the guideline for that guy? No.
Yeah.
We built the guideline for somebody who was married, probably a man, to a woman. Oh, holy shit. And then they have one job and they've worked there for 30 years.
30 years, and then they get a pension.
And then there's something I've got left over. Okay. None of my people, I'll raise my hand. I don't fit that.
Yeah.
Right. And everything is messed up as a result. And each of you, when I used to run InterThinks and our fraud detection business and trying to build technology at Cloud Virga, what we saw was this, it's not simple. And the client is so diverse and their income streams are so all over the place that nobody really fits. So we kept seeing the size of files go from 2006 and 7 and 8, where they were like, we had nothing in these files. There were just no income, no asset. What a bunch of idiots. Why would we do this? And then the files are like this.
Yep.
And they're asking you a bunch of stuff that doesn't matter. Like, where'd you get the money? Well, it either is in my bank and I earned it, it came from my parents and I got it, or I stole it.
Hey, are you
There's only
disciplined?
really three options, right?
But can we
And-
keep the
and-
money that's stolen as long as it's
And
a
with the
stolen-
Patriot Act, but look, that means SOAR. I mean, when you look at all the things that came out of, fraud of money coming into America and the Patriot Act starting it, and these initiatives that had to go through banks to keep people from doing it, that's why we ask all these questions.
It is, exactly. It's all the Patriot. Actually, now is a great time to mention, because we've talked about BOI business, the having to register your corporations by the end of the year. And a court in Texas, I believe, just decided that was not going to happen. So stand by on that. That's interesting to follow. So we had a comment in the chat asking Bill, who in our industry is going to replace Dave Stevens?
Dave Stevens
Said no one can
irreplaceable.
going to give it a try. And we're seeing I'm watching a bunch of guys on LinkedIn trying to replace Dave Stevens. As far as I'm concerned, you're the only one so far who
I
even
think Audrey, you should do it.
but I mean, we miss him desperately, but part of what we miss is, and you have it too, which is the linked loan officer, because what we see on what I see on LinkedIn, you've got a bunch of guys out there with a lot of extra time on their hands. They get a salary. They get paid every 2 weeks, no matter what the hell they do. So they're out there and they're trumpeting themselves and they are influencers and they're telling everyone what the deal is on everything. But there's a huge disconnect between them and the consumer. And so that is the part that gets lost in all of this is the consumer. Because if you're running a big corporation or a corporation, you are focused on what is your profit margin? Are you making money? Are you getting buybacks from the agencies? Like it's different. It's a totally different, and I hesitate to hire it because I get so sick of this higher lower crap. But anyway, bottom line is it's a whole different set of issues, but they're disconnected from the reality, as are a lot of the regulators and legislators about.
Well, and I think that's what you said, right? The reason we're sort of simpatico as people together is that, look, I started like each of you.
Yep.
I started I was a mortgage broker. I was hard money. Interest rates are 20. So I've done all of this and spent time in the business, and think about it just as you said. I think about it as the symbiotic relationship between the trusted advisor and the client is where it all begins and ends. Everything is good if that relationship is good. And I with each of you who originate loans, you are the most important cog, direct to originator. And what happens is when you create TPO, you create brokering, you create correspondent, you create now all these people that buy MSRs. In between that, you've got about 9 people between you and the money.
Yep.
And so my job is to slap you a little bit and say, I'm going to bring you closer. The originator has to be, there's only really 3 people in this thing. There's the borrower, the lender, and the investor. That's it. But yet, look at our business. If I walked into an IMB today and I asked them how many lending sources they have for one product, 30-year fixed rate loan, they have like 100. They have to manage LLPAs, MLPAs, pricing grids, comp plans. I mean, it's like when you're done, you're thinking, well, yeah, I'd rather be a broker myself.
Right.
Like I started, right? Why? Because it's simple, it's fast, it's efficient. And I think our job has to be, how do I empower the loan officer, whether it's broker or you're inside of an organization? How do I power that originator to actually be empowered to get shit done?
Exactly. And that's what I see, when we talk about, why is tech not working in a lot of instances? It's because there's a disconnect. I hear these guys at tech conferences, they get up on the stage and they're blah, blah, blah about their product. They don't have a clue how it impacts the borrower and whether it really works in conjunction to what the borrower needs. They're thinking,
or what the loan officer does to get the deal through. I mean, I was having.
There's such, but think
yesterday.
even what we've done, Kevin. So we've got, I mean, it used to be I did all my work, I then disclosed, and then I did all of this, and then so I did all the work. Now I've got a processor, an LOA, an input person, a disclosure desk, I got an appraisal thing, I got but by the time you're done, it's like you wonder why nothing ever funds.
Yes.
It's because that process. And the other thing that's wrong with that is that process plus all creating these net branches and little units within units, right? What's that add? Cost.
Yeah.
Huge cost. You gotta have a branch, you gotta have leadership, everybody's getting bips. I mean, that's what I said. I should just get shirts for each of all, and it should say bips on bips on bips. You should just have bips everywhere on the shirt, right? And I think what you've got to have is you've got to think about it, because this refinance boomlet is going to be different because of trigger leads, the product that you're going to need IOs and HELOCs and other things that are non-QM to start. And at the end of the day, we've got to get people on. They've got to be able to qualify. And the clients are getting more and more obtuse to the square 9.5 shoe.
Yep. Well,
right?
and
Just looking worse.
That little boomlet that happened in September, October, it was very different. So number one thing was speed. Those loans had to close fast or it didn't happen. So you better be nimble and you better not have long turn times or you're toast. The other thing that's different is we have really been hovering between 17 and 22% retention rate by the servicers up until now. That little boomlet, they retain 40%. And that is an issue.
Yeah.
And
one of my strategies, I think that's very well said, because I keep trying to prepare people. I know Stratmore does and people do, where they're saying this will be different. Well, it's different first because it's a cash out, and we don't do cash out well. The second is the yield curve is going to normalize, which means an IO is going to be better priced than a 30-year. We haven't had that in 10 years. Right. Then you got non-QM because all the guidelines you don't fit. Then you got the fourth piece, which is the single, and this is my Trump card, right? No, not Donald Trump. This is my Trump card, like a ace. I think that the biggest thing that's changed is the single family residence that we all put, and we built the entire industry around an owner occupied single family is no more. And you see it, the single family residence is like all these people, even in the chat, right? We got private equity taking over the single family residence. So what you've got is your residence is your home, it's your office, and you rent it. It's an income producing thing.
Yep.
And you may have 5 of them. Now, I may not even be able, given COVID, if you work from anywhere, I don't even know where you, right? So, and if the number one challenge in mortgage banking has always been owner occupancy fraud.
Yep.
And so what I like about non-QM is that we can take guidelines and actually tailor them to the client, and then we can actually fix, and we have, right? You have DSCR, you have these other programs for fix and flip, rehab, remodel, rebuild, bridge loan, all those things. And you need all of those things, and the agencies don't do that. And you all are agency people.
Well, and
you guys both said to me, you didn't, I mean, all of 2024, you didn't even do an agency loan until last week.
Yeah.
My first agency it's mostly non-QM and private money. And the thing about the non-QM, the biggest distinction is you have to have a conversation about a prepayment penalty with your borrowers. But let me tell you the upside to that. The upside is on an agency loan, you have an EPO that is going to be an issue and no prepay to help you. I mean, to protect you. If you have a 1-year prepay
you're protected
on a non-QM loan, you're protected. And the idea that the LO should bear the brunt, Bill, I can't tell you how pissed off I get when we see sweet guys, blah, 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 about how they own loans and how, of course, we should pay it back. I'm like, you get a salary. We don't. We get paid when we close a loan, and it takes a lot of damn work to close a loan.
It does.
Second is a lot of work. The same amount, frankly, as a first. So we're getting paid peanuts, and only when we close a loan, and then we bear the brunt of that. Come on. It's such crap. And by the way, just want to mention before you go, trigger leads bill is dead again this year, again. So
it's so funny that we worked our butts off as the MBA. You guys did too. And then, like a lot of these things, we get to the altar and then you can't find the bride. And in this case, it was terrible, right? Because we had put years of work into trigger, right? And how we do it. And whether you are so defeating, one of my 2025 events is how do we defeat trigger leads? How do we place ourselves in there? How do we do it right in the first place? And like Audrey said, the challenge is we're going to have to get in front of the MSR owner in order to compete for this loan when rates fall or they want cash out. So the only way you're going to be able to do that is to have better pricing or as good as or close, right? And you're going to have to be able to know when that client is thinking about it. And it's tough because the servicer who's basically been dead in the water for a long time is now almost revived themselves. And I do have to go. So sorry.
On Dan a couple weeks ago, and he was talking about the way that data is being used and how they're looking at everything from magazine subscriptions to, you know, what color your toilet paper is to see whether or not you're thinking of doing a loan anytime.
What you ask your Alexa or Siri to do, you know?
Yeah, geofencing, I mean, all this stuff. I mean, AI, I think is like an invasion of what you're thinking. But at the end of the day, I think the broker being local, you guys as originators, you're local. You just have to know. You have to go through your database, call them, be involved, because that's the only way that you can get in front of these trigger leads. And so go back through, like I'm telling all my clients, you got thousands of clients in these businesses, go back through all your clients, call them, set up an appointment, say, we want to talk about it. This is going to be a good year for you. I think you might want to think about, and then boom, then how do you stay connected to them? I think you're going to have low rate. You're going to have to be efficient, and you're going to have access to flips, ADUs, rehab, non-owner, HEI. I mean, all these things. But the key is you. You guys are great. Yep. Why would I want to make the largest financial decision I'm going to make on my own, especially to take cash out?
I literally talked about this last week where I had a client who, I mean, doing a 1031 exchange, I gave him like something that will save him $1 zillion as a, hey, by the way, did you think of that? And then at the end, he's like, oh, and by the way, I'm going to go apply with the credit union too. And I said, well, I won't be working with you then. And by the way, you're going to, I promise you, your credit union guy is not going to know what I just knew. And so he didn't. He applied with me. He gave me all his stuff. I've met with him since. He's on board. We have to absolutely embrace our value. And that means that you've got to be smarter than the guy at the credit union or in the call center or
and you all are
at the big bank when they go to get
the good news about 2025 is that banks are sort of dead in the water. Credit unions are always slow and sleepy. And the client in 2025 is a complicated client.
Yes, thank God.
This isn't where, oh, okay, anybody could do, a loan because the rate is 5 and I want 4. Okay, great. I mean, I even would send that one to Rocket or someplace else. I mean, I want a client that is my client that uses me because we're trying to build sustainable net worth. I'm trying to help you. In fact, a lot of my clients, I say, what are you thinking? Why would you borrow, you moron?
Yes.
You don't need the money. And what are you going to do? The problem with cash out is we never know what they're going to do with it.
Yep.
At least in a purchase, we know what they're doing. They're buying the stupid house.
Hey, Bill, come on. Always have them write a letter and they're always going to do whatever they say in their letter. Come on.
They never do that. Wait a minute. I have 2,000 letters here somewhere that I just pull out of my, so I got to take off. I love you guys.
Thank you.
Bill.
Hang in there.
Thank you.
Keep going, Bill. Okay, so Bill told us he had a hard stop at 11:50 and he gave us 7 extra minutes. So
Yeah, that's pretty good.
grateful. Just a couple more things. Number one, CFPB just announced that they're returning $1.8 billion in illegal junk fees to 4.3 million Americans who were taken advantage of by Lexington Law and creditrepair.com. So first of all, I just want to start with creditrepair.com. Doesn't it seem like that should be the go-to source for all things that you need to know about credit repair, but yet they were part of the problem. And so anyway, that's interesting. I've always wondered, where does all the money go? Apparently some of it is finally going back to the
Well,
borrowers.
hopefully it actually gets to the borrower's hands. That's the other trick.
1.8.
I've gotten one of those ones where I think it was, I forget the lender now, Aquin, and they used to charge every time you did a electronic payment, they would charge you for it. I'm like, what's up with this? And then sure enough, CFPB came along and said, yeah, you can't charge it. Well, I paid, $15 every time I made an electronic payment, maybe 4 or 5 times a year. And how much money did I get when they finally got the settlement? It was like $27. Like,
Well, okay, so I had somebody ask the question that I thought was interesting. Are Amazon sales included in the retail sales numbers? And this is what I found. So retail sales numbers do include Amazon. And in 2023, Amazon accounted for 10% of all gross retail sales in the US. They're the world's online retail.
what percentage?
10%. 10%. That's huge. Okay,
Yeah.
what's weird, and because we're seeing the retail sales numbers come in and they're strong. They're really strong. And yet we're hearing from the ground that the local retailers are really struggling. So just again, go support your clients' businesses, go shop locally if you can.
Shop local. I honestly believe states need to now no longer tax retail sales at the local level and need to overtax on because what that does is it's sending all that internet money is going to Silicon Valley, Seattle, Austin, Texas, and those 3 big cities are making bootloads of money. That's why I see it in the Bay Area. Why there's so much money here? It's all internet. Go shop local.
I love the idea of giving people a break on local sales tax. Good luck on getting your city to embrace that idea. None of them will. I would love to see it. Just a reminder, as you're preparing your business plans for 2025, which I know everyone is either done or is working on, right, Kevin?
Oh, yeah.
Average age of a repeat buyer is 61 years old. Don't forget that. We've gone way up in the age of the average age.
Yeah.
Make sure that you're not just targeting millennials. The first-time home buyers are only 24% of the market now. They were closer to 30 for the
I have first-time home buyers right now, and they are ages 61 and 59. First-time home buyers.
Yes, it's unbelievable. And of the 136 million households in the US, 91% of them own and 45 million of them rent. And we've had a huge influx of immigrants in the last 3 years, 700,000 more households, and 600,000 of those households are renting. So potential buyers. So again, just be thinking of some of these things as you're putting your business plans together. And with that, we are done, and we will see you next week. Our last show of the year. Can you believe it? Crazy. So everyone go get a loan. I'm busy right now, like really, really, really busy. So go get
busier.
Get them closed. There's loans to be had. All right. Have a great week, everyone. Kisses. Bye.